Hi guys, let's start with the most important aspect of IFRS 18, that is the five financial categories of incomes and expenses. So IFRS 18 basically tells you to categorize your incomes and expenses into five categories or five subtotals rather. Okay, what are the five categories or the headings? The first three are basically the same which you have learned in your cash flow statement topic. Okay, so whatever the three categories are there in cash flows, the same three categories are now required in P&L as well. What are the three categories? First one is your operating activities, second one is your financing activities, and the third one is your investing activities, right? So the same three categories are now required in profit and loss as well. So earlier we were only doing the categorization for cash flows. Now we need to do it for P&L, incomes and expense items as well. Okay. And then what are the other two? So you said total five categories are there. What are the other two? The other two are one related to taxes and the other one related to discontinued operations. We'll see later. Just stick with me. Okay. So what are the first three? Operating, financing and investing. So let's start with the first one. Operating category. Sir, means what? Items that are related to your core operations or your major operations of the business, like for example sales, expenses, salaries, electricity, telephone, everything else. So every expense or income related to your main revenue generating activities, whatever is your primary business, I can call it in short as your primary business. Okay, so everything related to your primary business should be covered under the operating category. Now examples: revenue from sale of goods and services, cost of goods sold, salaries and wages, depreciation on production assets, impairment on operating assets. Sir, assets, not all assets, not all depreciation will be shown in operating, only depreciation related to production assets. Means assets that are used for production, that depreciation will go into operating category. So if you have assets that are not used for operating activities, then that depreciation also should not be in operating activities. That's what I told you. IFRS 18 will give you better understanding and also better guidance on how to present and where to present. Okay, see here. If there is a manufacturing company, it would classify the revenue from selling finished goods, raw material cost, factory overheads, utilities, equipment depreciation, all of this will be operating. Similarly, if it is a bank, sir, for bank, they won't have revenue from selling the finished goods. Bank will have what? Interest income and interest expenditure. So interest income, any fees that they collected like account maintenance charges, minimum balance charges, or whatever credit card late payment charges, that is what revenue for the bank. They all will be considered as operating. They are not financing. Sir, interest is usually considered as financing, but for a bank, interest is not financing. Interest is its operations. That is their primary nature of business. They reflect the bank's primary business model. I hope you are getting the picture. So everything that is related to the core operations, the primary business activities, is operating. It depends on the type of the business. Next, second category is what? Investing activities or investing category. So investments that are not directly linked to the core operations. Sir, what? Investments. You are making investments, but they are not related to the core operations. They are related to surplus money being invested in some place. Like for example, a manufacturing company is there. They had surplus money, so they deposited that in a government security. Let's say they purchased some T-bills, or they purchased some fixed deposit. They made a fixed deposit, or they purchased some corporate bond, whatever it is. Now they are getting some interest on that. That is an investing category item. Sir, bank is getting an interest. That is an operating category item. So it depends on the nature of the business, right? So this typically include returns on the surplus funds or investments made outside the entity's central business model. Sir, for example, if I'm talking about a mutual fund company, investing is their major area of business. For an investment company, for a mutual fund, investing is the main source of business. So returns on investment is not investing category for them. For them, it is operating category, right? So I hope you are able to comprehensively see the bigger picture here. So interest income on T-bills or dividend income on equity, rental income from investment property, fair value gains or losses on investment properties. Sir, these two are investment property related. IAS 40. Right, so that should go into investing category, not into operating activities. Sir, what if I'm a real estate company or I'm a rental agency? So we purchase properties and we give them out on lease or rent. Then what will happen? Then these two, rental income and fair value gains or losses on those items, will go into operating category. So don't by heart the item here, don't by heart the example. Understand the nature of the business, and based on that, classification or categorization will be there. Okay, so for a rental company, rental income is an operating activity, right? For an insurance company, investing might be one of their operating activities. Sir, sir, you really need to learn, you really need to know the practical implications. Sir, LIC is there, Life Insurance Corporation Private Limited is there. Sorry, not Private Limited. Life Insurance Corporate Limited is there, LIC company. It's an insurance company, Life Insurance Corporation. Sir, then investing, they do investing. What do you think LIC does? Okay, see, I'll be shocked and surprised if you don't know this. Let me just show you. LIC investments. Let's say in ITC company. So Life Insurance Corporation, LIC, holds 15% equity in ITC, which is valued at 80,000 crores. Simple. LIC has invested 80,000 crores, 15% of ITC. Okay, let me take IRCTC for example. LIC is holding how much? Approximately 10%, 9.3% stake, and this increase represents 2% rise in their holding acquired through open market purchase between December 22 to September 24, blah 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 blah. Now they hold across 7 crores shares in IRCTC. Okay, similarly, if I take Adani, I think LIC has reduced their stake in Adani. Yeah, LIC just invested 5,000 crores in Adani ports recently. So you get the picture, right? So this is done in June 2025. Yeah, 3rd June 2025. So one of the major purposes and activities of LIC is to invest. What do you think they do with all the premiums that they collect? They invest it. That is where ELIPs or ULIPs come from. ELIP is okay, that is property. I think they are calling it ULIP, unit linked insurance something. Yeah, unit linked insurance plan. How do you think they work? So whatever premium you pay, they invest it. So if the investments increase in value, your returns on this ULIP will increase. Okay, so you can see here what is a ULIP and all that stuff. Okay, this is not an insurance lecture, so I'll skip that, but I hope you got the picture. So if it is one of the major operations of your business is to invest, then interest, equity, profits, everything will be operating, not investing. If your major operations is something else and surplus money you are investing, that is an investing category. Same thing will apply for cash flow statement also, by the way. Okay, sure. Retail business, if it is investing its in excess cash in the government bonds, then any interest they received would be investing category. If a bank is receiving interest on the loans that they have given, that is operating activity, right? Next one, financing category. Financing means what? Sources of funds. Where did we raise the money from? So any interest or dividend or whatever you pay back, that is a financing category. So it includes incomes and expenses associated with raising finance, including interest payment on loans and bonds and other stuff. Sir, what about dividend? But dividend is not an expenditure. Dividend paid by the company is not an expenditure. It is allocation of profits. Okay, so whatever profit you earn, some of it is distributed, not spent. You don't spend on dividends, you distribute the dividends. Whatever profit you earn, out of that some portion is distributed as dividend. It is not an expenditure, it is allocation or appropriation of the existing profit, or distribution of profit would be a better term. And then retained earnings, the balance would go into retained earnings, right? So dividends are not an expenditure, so they cannot be called as financing expenses. In cash flow statement, they'll be shown as outflows under financing activity. But in P&L, they are not an expenditure. Be very careful. I know even after repeating this so clearly, most of you will make this mistake. Most of you will get confused between P&L and cash flow. And in P&L, you will show dividends paid under financing category. No. In cash flows, dividends paid will be outflows. But in P&L, dividend paid is not shown. It is not an expenditure. Okay. So what else will be there in financing? If you borrowed anything outside, from outside, then the interest, financing, issuance cost of the debt instruments, all of this will be financing category. Like a tech company taking out a term loan to finance the new infrastructure would classify the interest cost under financing activity. Okay. So what are the three activities? Operating, financing, and operating, investing, and financing activities. Sir, what if I have an item which is not under any of this? What if I have a special item? Okay, please don't worry. Operating category is a residual category. Means if something is not explicitly categorized as investing or financing, listen carefully. If something is not explicitly categorized in the next 2 plus 2, 4, total 5 categories are there. If anything is not falling within the other 4 categories, it should be shown in the operating only. Okay, that's why it is called as the residual category. So 3 categories are done. What are those? Operating, major business activities, and residual. Next, investing and financing. Next one, 4th category is income taxes. Self-explanatory. All taxes, deferred taxes, income taxes, any foreign exchange adjustments related to these taxes will be shown under taxes category. So current corporate income tax, deferred taxes, property taxes, everything, all kinds of taxes. FX differences related to the tax payments should also be shown under this category. So regarding FX differences, I remember putting a note point. Let me just quickly check. Yeah, special point. This one. Yeah. Foreign exchange differences. So where shall we show forex gains or losses? Simple. Forex gains or losses either relate to a transaction or to a balance. Correct? So wherever that transaction is categorized, forex adjustment related to that transaction also should be in that same category. Sir, I did not understand. Simple. Sales is there. You sold some item. On that you had some foreign exchange gain. Sales is an operating activity. So forex gain on sales is also under operating. Sir, I paid some interest to a bank loan. That is an financing activity. So any forex gains or losses related to that also should be forex activity. So you will have foreign exchange in all the 5 categories. Forex gains or losses will be there in all the 5 categories. I hope that made sense to you now. Earlier it was only one line item. Now it will be shown in each category. Next, 5th one, 5th category. 4 categories are our operating, investing, financing, taxes. 5th one is discontinued operations. Discontinued operations means whatever business activities you have either shut down or in the planning to shut down phase in the next 1 year, they are all discontinued operations. You have a separate standard on discontinued operations. I'll not touch base on that in this lecture. Already I'm going too much into the detail of IFRS 18. I know that. I'll take more than 1 hour or 1.5 hours, at least 1.5 hours to 2 hours I'll take on IFRS 18. If I go into each standard, it will take 10 hours. So I'll not do that. So discontinued operations related loss from disposal of a division, profit on a discontinued subsidiary, all of these will be there in the discontinued operations. So quick summary, what is there? Operating activities is main business activity. Investing is from investments. Financing is related to obtaining the funds. Income taxes related to tax expense or losses. Discontinued operations related to operations that have been past or will be discontinued, past or future, will be discontinued next 12 months. Within the end of the next reporting period would be a better terminology. Some examples were also given. Okay, please pay attention to the special points. That's why I put a separate heading on that. First one, the operating category is a residual category. If an item does not fit the criteria for investing, financing, income taxes or discontinued, it will be classified as operating. If something cannot fall into the other four, it will be in the operating, even though it is not related to your primary business. Sometimes happens. IFRS 18 sets out some more detailed rules on how to classify incomes and expenses related to derivatives and hedging instruments. Sir, financial reporting students, don't even worry about derivatives and hedging instruments. SBR and IFRS students, you already know about that. Derivative instruments, hedging instruments are there. So effective portion of a cash flow hedge will be taken in the OCI. Ineffective portion will go into P&L. You already have that classification in the respective standard. That only will be followed here. No, nothing different, nothing extraordinary or anything like that. Stick with that. Okay. Sure. So foreign exchange, as I already told you, it will be there in each category will have a foreign exchange. All right, guys. So that is about the 5 categories in IAS 1 versus IFRS 18. But before winding this lecture, I want to show you the presentation also, so that I can cover one extra topic here. All right. So this, what you see on your screen is a screenshot, because in Word you cannot present it so neatly, so I had to put it in Excel and then take a screenshot and paste it here. So it is a little here and there, but that's okay. It's clear only. I am seeing the preview and it's clear. Okay. So this is as for IAS 1. Be very careful. IAS 1. This is not IFRS 18. So for the financial year ended 31st December 2025, so statement of profit and loss and other comprehensive income, P&L, you have revenue minus cost of goods sold, gross profit, plus other operating expenses, minus selling and division, minus administrative expenses. That gives you operating profit, which is also called PBIT. Then plus interest income, plus minus fair value loss on investment income. There's the loss now. Fair value loss on investment, finance costs are subtracted, then you got PBT, profit before tax, then minus tax, then you got profit for the year or profit after tax. Then below that you have the other comprehensive income, revaluation loss on PPE is there. So this is net of tax. OCI items are always shown net of taxes. I hope you remember that. Correct? So that is there. This is the standard what we see in IAS 1. Now let's see IFRS 18. Slightly different, same calculation, slightly different presentation. IFRS 18 for the year ended 31st March December 2025, all amounts in dollars and in thousands of dollars. Statement of profit and loss is given. So you have your revenue from sale of goods minus cost of sales. Sir, that is same thing, na sir? Yes, revenue, but instead of calling it just revenue, we call it revenue from sale of goods. More detailed labeling is required. Minus cost of sales is gross profit, and here is what sir, selling expenses, the administrative expenses, government grant income, these were all under SG&A there. Under IAS 1 previously it was under SG&A, incomes and expenses. Here it has to be a part of operating profit. Category A is operating profit. I hope now you are able to understand. Second, investing category. Sir, heading here operating category. Second heading is investing category. Interest income on deposits, fair value loss on equity investments. This is net investment income. Then third category, financing, interest expense on bank loan. Fourth category is profit before taxes and income tax expense. This is tax category, or basically as I told you, these 3 are major categories. The other 2 are subtotals. So you may or may not, you can put a category here, tax category and discontinued operations category, not mandatory. Okay, anyways, so I'll put it here, tax category. Okay, in this example I did not include any discontinued operations, so that is not there. And then OCI will still be the same. There is no segregation of OCI. OCI is still the same. So now let's see side by side IAS 1 versus IFRS 18. So you can see the profit figure is same. 1450 profit figure is the same. No problem there. Okay, all the values will still be the same. There are no differences in the values, just how they are presented will be slightly different. So here it is revenue, here it is revenue from sale of goods, better description, cost of sales, gross profit, here also 4,000, here also 4,000. Then you have other operating income. Here labeling is other operating, here it is government grant income. Clear description should be there. Selling and distribution, selling expenses. Administrative expenses. Now here it was operating profit, here also operating profit, but here profit and loss section, here it is operating category. Category wise subheadings should be there. Next, after that, interest income and fair value loss and finance cost. All three items are clubbed under one section, but here investing category, financing category is split. So these two are investing, this finance cost is financing activities. Now under this finance cost, earlier it was just shown as finance cost 500. Now it is interest expense on bank loan 500. Better description. Interest income, investment, interest income on deposits, fair value loss on investment, fair value loss on equity investment. So it is more descriptive and very clear. Okay, sure. I think that is more than sufficient. I hope you all got the picture as how it is different compared from IAS 1 and IFRS 18. So now you tell me, will it make sense to like reteach you all the standards just because the presentation structure has slightly changed? No. So that is the reason why I will not redo all the lectures again. I'll leave all the standards like that. This IFRS 18 lectures I'll add to your existing course. Okay. So that way you will learn what is new, but essentially presentation will change, the categories and the side headings will change, but the structure is still the same. I mean, the ideology is still the same. So I'll not redo the entire syllabus again. So I'll leave it like that. Okay guys, so with that I'll wind up this lecture. In the next video we'll talk about the categorizations, that is whether presented by function or whether it is presented by nature, or there is a hybrid mixed approach. So we'll talk about those approaches. Okay. Yeah. Just before I wind up, there are this is something that I already covered, but again I'm touch basing on that just to be sure. So here gross profit, operating profit, profit before taxes, profit for the year, same side headings, same subtotals will be here also. Gross profit, operating profit, then you have profit for the year, total comprehensive income. So these subheadings, subtotals are mandatory. What are mandatory? Operating profit, profit or loss before financing and income taxes, that is operating profit only. Net profit or loss, you can see here operating profit or loss, profit before financing and income taxes, after investments. Okay, after investments. Then profit before taxes, profit for the year from continuing, total profit for the year. These side headings, or not side headings, subtotals. These subtotals are mandatory. What are those? Operating profit, profit before financing and income taxes, profit before tax. If you have discontinued operations, then profit from continuing, then total profit. 5 subheadings are mandatory. 1, 2, 3, 4, 5. Fourth one, in case if you have discontinued operations, you will show this. Otherwise, it will be the same. You will not have fourth one. Directly, you will have the total profit for the year. Okay. Sir, if these 5 are mandatory, can I add more? Yes, you can add more. No problem. See, entities may include additional subtotals within the P&L to offer useful structured summary if it is needed. The subtotals are derived from amounts recognized and measured in accordance with the IFRS standards. They should be consistently applied. It should give you better emphasis on the subtotals. Profit before tax, profit from continuing operations. These are the additional subtotals that we are talking about. It makes sense to have them anyways. So 3 and 4 are additional. In this 5, 1, 2 and 5 are mandatory, 3 and 4 are additional, which is again better to have it. Alright, chalo. So with that I'll wind this up. In the next video we'll talk about the classification by nature, presentation by nature or presentation by function and the hybrid approach. Okay guys, see you soon. Keep smiling. Take care. Bye bye.